Well, there's volatility in the stock market, and tech stocks are playing a key role. Joining us this morning is Stephan Miskjian of Miskjian Investment Consulting, and we want to thank you for coming in. Welcome back to the show. So the market is at all-time highs, and yet big market tech leaders like Google and Amazon are down 20% or more in just the last couple of months. What's really happening?
Yeah, so these high-flying tech names like Google, Amazon, Facebook, and Netflix, they've dropped about 20% on average over the last 2 months. They were actually down more. But people need to take a look at the longer picture. Google, even with this drop, is still up 100% over the last 4 years. Facebook is up 100% just over the last year. Amazon is up 200% over the last 4 years. Netflix is up 500% over the last year and a half. So these high-flying tech names, they've done really, really well. We're in the 6th year of a bull market. People are getting nervous, and we're starting to see a sector rotation out of these high-flying, risky names into more conservative sectors like consumer staples, like big energy, that are more stable and less risky. And that's why these names have dropped.
Okay, so should we be worried about another 2000 bear market when technology stocks collapsed?
Yeah, 2000 was a horrendous year for technology. And if you look at the high in 2000 to the low in 2003, technology stocks fell about 75% on average. That almost rivals the Great Depression, where stocks lost 90%. So are we going to have another 2000? The answer is probably not. And because stock valuations are not excessively high like they were back then, we look at the NASDAQ index, which is a barometer of technology stocks. Back then it had a value of 5,000. 14 years later, it has not fully recovered. It has a value of 4,000, even though the companies inside there are stronger, more profitable, more financially healthy. We look at the S&P 500 index, which is a broad market barometer. And back in 2000, it had a PE ratio of over 40. PE ratio is a market valuation measure. The higher the number, the more overvalued stocks are. So back in 2000, we were over 40. In 2014, we're under 20.
Wow. So what should investors be doing now?
Yeah, so if you own these individual high-flying, risky names, understand what you have. They are extremely volatile. They're going to go up a lot. They're going to go down a lot. If you can't stomach that, it may be worth to own mutual funds where you get a broad basket of stocks and you have more diversification and less risk. Consider taking some profits. Let's say you bought Netflix a year and a half ago. You probably paid about $60. You watched it go up to $450, and now it's at $350. You still have a very nice profit there. Consider taking some profits. Do not look at it as a stock that, oh, it was at 450, now it's at 350. I'm losing money. I can't sell it. That's not a good way to look at it. Finally, look at your overall asset allocation. Stocks, bonds, and cash. Is it appropriate for you? We've had this big run up in stocks. People may be overvalued in stocks near this market high that we're at right now, and maybe should consider rebalancing.